Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Going into the Fed decision with a quarter-point cut expected, the path forward is much, much murkier. Lisa Shalett of Morgan Stanley saying the implication of 2025 is that it will be tough for more cuts and disinflationary growth acceleration to both play out. We believe that growth will likely disappoint first and further Fed action will be constrained. Lisa joins us now for more. Lisa, it's good to see you.
It's great to see you, Jonathan.
Let's build on that. Why will further Fed action be constrained in 2025?
So our perspective is we're already seeing inflationary pressures build. Again, I know that the traditional economists among us like to, take apart the data to fit the narrative that they've assumed. But when we just look at the top line data, we've had 4 months of accelerating core CPI data. Flat out, and that's with the advantage and the tailwind of a 20% drop in oil prices year over year. If in fact oil prices have bottomed out because global growth has bottomed out, and that if we assume that some of the cuts that have been put into the global system start to take effect in 2026, if we get a little bit of stimulus out of China, if oil starts coming back and we look at some of the dynamics in inflation, we could have very sticky inflation last year. I mean, this last print, you had goods prices up and food and grocery prices led the way.
Bigger, not hotter was a theme for 2024.
Yes.
You've referenced that in your note.
Yes.
Why do you think that changes? What underpins that change going into next year? Bigger and hotter?
Yeah, so, our sense is that animal spirits are real. Clearly, there's an enthusiasm and an expectation, that folks should be investing. But at the same time, our sense is that demand can outstrip supply here. We continue to have this have and have not economy where, the largest corporations, the richest households are somewhat, interest rate insensitive. And they've been powering consumption in this economy really for 2.5 to 3 years now. And the sentiment among those two cohorts is pretty strong right now.
So when you start to talk about this idea that we could see a downside to growth and that we could see more weakness than people expect with ongoing stickiness to inflation, I mean, that kind of sounds like dreaded stagflation.
Yes,
is that kind of where you're going with this?
It is. And it's one of the things, that we've kind of said is sequencing will matter. We expect that we're going to get a barrage, literally a machine gun of policy proposals, right? You guys, as journalists, are accustomed to the 10 headlines a day, and he tries to figure out, okay, which 4 stick of the 10, and then he goes with those 4 and another 6 the next day. Our best guess is that barrage is going to create a level of noise that does undermine some of that animal spirits and creates uncertainty for the other 60% of the economy, the low-end consumer, the smaller cap companies, because they can't figure it out. And so I think it's that we're going to see early in the year. There's an unbelievable, sense that, hey, consumers are going to get tax cuts. No, they're not. Not in 2025, where it's going to be on a derivative basis, on the first and second derivative or the rates of change, right? Your taxes are going to be exactly the same in 2025, right? There's no tailwind, right? That's all coming in 2026.
And this is the reason why, in some ways, you're advocating to unwind some of the Trump trades that people have put on. Can you talk about which you think are most vulnerable to the reality check of sequencing, to the reality check of the delay of how long it will take to implement?
So look, I think that, some of these Trump trades have been so staggering, it's almost obvious. The cryptocurrency trades, up 50% in 50 trading days, extraordinary. We have, Tesla, similar type of move. I think some of the small cap move has begun to fade, in the last 10 days. Our best guess is the fading of that small cap trade is what reflects this potential stagflation. That, hey, wait a minute, everything's great, but maybe it's not great for us, because we're still, broadly a set of unprofitable companies that have, struggled to deliver upside surprise in earnings.
So do you still like gold?
We still do like gold here, and for us, the gold story really is about inflation and dollar debasement. It's a lot about this debt and deficit story. Again, the bond market has sniffed out this joke, and on various days you see, some folks trying to express a desire for term premium in the long end of the curve. Our best guess is as these debates get underway, the debt and deficit storyline is going to have to
so do you think
get higher profile.
We're at the peak dollar right now?
I don't know if we're probably close to peak dollar, but look, I think a lot of things are at play here, and one of the things that I think is a profound risk, again, this is not a market that's pricing many risks, but we have an extraordinarily bifurcated currency market around the world where the dollar is strong versus virtually every other currency. If, in fact, we come out, on day one after the inauguration and are extraordinarily aggressive with China, I think that there's a non-zero risk that China could come back and say, okay, we're devaluing. A devaluation of the renminbi would be hugely destabilizing across the global trade complex. And, those types of risks are just not being priced right here. So, is the dollar at peak strength? I'm not sure. But I think we're getting close, and we're just at this very fragile and unstable place.
If someone were to hear everything that you put together, they would say, wow, what a raging bear. Oh my God, you must be predicting 4,200 for next year.
No, not at all.
Okay, so let's talk about why not, because basically you're talking about debasement of the dollar and the end of the Trump trade and stagflation. So give us where you really are with this.
So look, I think that there are risks out there that we want to see priced. At the same time, there is value because this is an extraordinarily bifurcated market. So we're saying that this is going to be an environment where there are winners and losers. So we do see some winners, right? So we see financials, we see domestic industrials, we see portions of consumer services that, again, are domestically based as big winners here. We recently upgraded mid-cap growth companies as areas. We've built some diversification. We're owning, Japan. We're owning some parts of emerging markets. So we think that there are things to do out there. We think that this is a index that next year can chug along at the index level, maybe give you 5 to 7%. But at the same time, what we're saying is if you're getting 5 to 7% in a stock market that is extraordinarily richly priced on extraordinarily ambitious expectations, why not own a better risk-adjusted return in an investment-grade bond and clip the coop and just, make it to the end of the year?
You mentioned EM. What do you like in EM? Which part?
So we've been long bulls on India. We know India has stalled out. We think Mexico is way oversold, and that by the end of the year, we're going to find a better footing there, and some of the tensions with the U.S. Will be mitigated. Brazil, obviously, now significantly tightening. We believe that that's going to get priced and that there's going to be opportunities, to buy some value in Brazil.
I've got the foreign exchange screen in front of me. Year-to-date emerging markets. It's amazing. The peso in Mexico down 16%. In Brazil, the currency down by more than 20%. Likewise in Argentina. Go up to Russia, down 13%. In Hungary, down 11%. Colombia down 11. Double-digit moves in foreign exchange in EM.
You have to wonder at what point you hit sort of a bottom, given the fact that you have a lot of potential trade wars being priced in.
Yeah.
Lisa Shalett, it's good to see you, as
Great
always.
to see you.
Appreciate your time. Thank you.
Thank you.
Lisa Shalett there of Morgan Stanley. We begin this hour with stocks higher ahead of the final Fed decision of the year. Victoria Fernandez of Crossmark saying the problem is that both sides of the dual mandate are heating up. The question comes down to, is the Fed still restrictive? And according to Powell, the answer is yes. Victoria joins us now for more. What's the answer according to you?
I don't think we're as restrictive as the Fed wants us to believe. I mean, you look at growth. You've got Atlanta Fed GDP now, 3.3%. You've got inflation. We had CPI and PPI reports come out. Big revisions there, inflation being sticky, and you have really high sentiment right now. Look at NFIB, small business, 3-year high on sentiment. You've got bull-bear ratios, very strong on the bulls. Now, that can be a contrarian signal, I get that, but you still have really strong sentiment that is out there. With these elements, I don't know how you can say this economy feels restrictive. I say, yes, there are underlying elements, right, under the surface that I think will start bubbling up, but I don't think it will be until early next year.
But isn't that disconnect just super bullish? So long as the Federal Reserve Chair thinks they're restrictive and keeps cutting interest rates, isn't that just a green light just to keep on buying?
It is for now, and I think that's why you're seeing the market continue to move up. Yes, the past few days we've had a little bit more volatility in play, but the market is going, and you've got the seasonality along with it. You've got earnings expectations that people think, I think a little optimistic, but double-digit growth again next year in earnings. You're not having the labor market completely fall apart. So I do think there's elements that are tailwinds to this economy, and you add Powell in, which I know you said you think it'll be boring, Amory, but I do think he's going to come out and say the same. We're data-dependent, recalibration, blah, 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 and everyone's just going to look to the dot plot, regardless of what Jim Bullard said earlier. They're going to look to that dot plot and go, what are you really thinking?
I don't think it's going to be boring. I think it's going to be fascinating, and I cannot wait for the meeting and the dot plot and the press conference afterwards, in particular, because as you're saying, that this is a tailwind, essentially the idea of a Fed cutting. There is a question of for what assets? Is it a tailwind for stocks? Is it a tailwind for bonds at a time where you have a real discussion longer term about whether this actually increases the chance of stickier inflation over 2025 and 2026? What do you expect to be the reaction in the bond market, particularly at the longer end, should this be a Fed that does lean more dovish than, say, what the market is expecting?
Yeah, if you get a more dovish feel to the press conference, I do think you'll have equity markets rally a little bit, and bond yields will probably come down, at least in the near term. I think they come down a little bit with the expectation that the Fed will continue to cut. However, bond vigilantes are not going to be happy with that. So let's give it a little bit of time. I think they'll come in, they'll start singing, and we'll see yields move up intermediate term from there. But the initial reaction, if the Fed is dovish, I think you'll see yields come down a little bit.
That raises this question about whether the market does not believe inflation to actually be a real threat. I mean, which is it? It seems like there are different messages from different asset classes. In the bond market, it seems like there isn't a great deal of concern, but it's definitely a sense that things are stickier. And then the stock market, they're just saying, we don't care. If it's mildly inflationary, that's great. Let's go.
Right. And there's other elements that could cause inflation to go higher. It's why it's such a difficult story right now. I mean, we don't know what tariffs are going to do exactly. We don't know what kind of corporate tax cuts or individual tax cuts are coming in, and is that going to be inflationary? I think the key to a lot of this, though, is productivity. That can really be the element that comes in and buffers inflation and helps growth move higher. So if the expectation is that you're going to get some productivity coming in, maybe that's one reason why the markets are not as concerned right now with what inflation is saying.
Well, Jay Powell won't assume what Trump 2.0 will look like, but the market certainly is. What sectors do you think will do well next year?
Well, a lot of it depends on the policies that we see come through, but I think you can imagine we'll probably have CapEx stronger going forward. If you have federal spending come down, that helps on CapEx. It helps corporations in regards to margins. So I think you'll see industrials do well. I've liked financials all year. It's been a story we've had. I think you'll continue to see financials do well. They've had a little bit of consolidation, but you have that deregulation story coming in. You have a positive yield curve. Loan growth should grow. M&A should grow. low, so that gives you some bumps there on financials as well. We don't invest in crypto, so I'm not going to say that, but it's been going a little crazy there.
You like industrials because potentially the tax rate story, right?
Tax rate and CapEx, I think we continue to see grow in onshoring.
But what about tariffs?
Yeah, I mean, I think we have to separate the tariff story out, and you probably know better than I do when we look at the history of this. I think when you're talking about tariffs as it relates to China, that's one story. I think we can assume that that's going to be pretty quickly. After January 20th, we're going to see some movement there. When you're looking at tariffs for the rest of the world, I know there's been a lot of talks in the conversations with Canada and the conversations with Mexico, but I think that's a different story, and I wouldn't anticipate we're going to see those come to fruition as quickly or maybe as high a level of tariff is what we're hearing right now.
Let's talk about breath. Bad breath. We've been seeing a lot of bad breath over the past 12 days throughout the entire month of December. And it raises the question, is this a taste of what's to come next year? Or if this basically is just a breather of the Trump trade and it will reassert itself come 2025. Where do you fall on that?
I think we do have to be a little bit concerned here. I know we're having a little revival here and tech names are doing well. Yes, NVIDIA's pulling back, but Broadcom's stepping in. So we're seeing those go. But then you look at how much concentration there is in these names. I mean, top 10 names are 37, 38% of the weight of the S&P 500. So you don't have that diversification. You're seeing a little bit more breadth down cap, but I think we have to be concerned when we hit next year and you have the debt ceiling crisis come in and we start to see tariffs go into play. I think we have a little more volatility next year. I don't think this is just a small pause and then we're going to go full on bull market from here. I do think there are some concerns that we have to be leery about.
What's the hedge at a time where there's equal risks of both some sort of acceleration in inflation or a downturn?
For us and for our clients, it's really being diversified. So not just in your stock picks that you have, but yes, we want to be in the market. You've got tailwinds going right now. I mean, path of least resistance is higher for now, so you don't want to ignore that. You want to be in that market. But we like those areas we talked about. Put some names in financials. Look at some of the industrials, longer term play. You know, I'm a fixed income person, so I think you still lock in some of these rates. We maybe go up to a 4.75 or so on the 10-year. I think you can lock that in because with global rates as low as they are, I mean, you look at Germany, you're like 2.5, right? We look and see what's happening in China. I think you can capture some of that as well and have some exposure.
The SNB talking about how negative rates do work. Do you like anything when you're looking at diversifying outside of the United States?
It's tough right now. I would have said a few months ago, yes, put your toe into Europe. I think that they're going to start to see things with the ECB cutting rates. But the issues that we're seeing out of France, the issues that we're seeing out of Germany, the poor manufacturing there, I mean, we have it here, but it's even worse there. We're seeing a 230 basis point differential between UK and German 10 years. I think you have to be concerned. I need to see a little bit more positive movement coming out of Europe before I think you go there. And Asia, I think, you know, there's some concerns there in China as well. Domestic demand is really slow. We saw it in retail sales. They had the highest month of outflows, like 46 billion last month. So I think there's some concern there. I think you got to stick with the U.S. for now.
Disinflationary, deflationary traps are difficult to get out of. Japan lived it. Europe went through it for a while. Are we seeing that start to take place in China? Is that what that chart of Chinese government bond yields is all about? Is that what it says?
I think that's part of it, but I also think when they're looking at tariffs that could be coming, you see some flight out for that reason too. There's some concern. You have China saying that they're going to be more proactive in regards to the stimulus that they put forward. They upped their federal deficit. They're saying it's going to be 4% now next year instead of 3%. Not a huge move, but they're trying to do some things. There is somewhat of a trap there you have to be leery of.
Bond market doesn't believe them. Looking at that chart, doesn't believe them at all.
And neither do a lot of other people. I mean, there is sort of a sugar high in the equity markets, perhaps, but realistically, are they going to be able to juice growth at a time where consumers are reluctant to spend? That ultimately is the question.
Victoria, good to see you. Great to catch up. Thanks for being here. Victoria Fernandez there of Crossmark Global. Nikolayevsky is the founder and CIO of long-short firm Axel Capital Management and has been betting on the name since 2023. I'm pleased to say that Anna's with us now. Anna, good morning.
Good morning. How are you? Thank you for having me.
It's good to see you. It's been a great year for some chip makers, but not all.
True.
It depends what you're exposed to, PC, smartphone, data centers. When we talk about Micron, what kind of exposure are we talking about?
I think at the moment people are expecting the quarter to have up ASPs in the 5% range. I think the ASPs going forward may actually be flat to down, and you're probably not going to see a recovery until the back half of 2025 because there's going to be a little bit of a push out for smartphones and PCs at the moment.
What is it about the back end of 25 where you start to get a better tailwind for those kind of businesses?
There's going to be a replacement cycle.
Across smartphones?
Across smartphones and PCs, I think at the moment you are not seeing 100% adoption by the consumer of AI PCs. I think Best Buy has hired several thousands of people to help train consumers on the AI PCs, but there's no major uptake right now for the Christmas season as far as I'm hearing. So there may be an uptick later on next year when there's a natural upgrade cycle for enterprise and consumer.
What's fascinating to me is that people have been trying to pick the next NVIDIA, the next big winner from the whole chip cycle, and the fact that we've seen some real massive winners. Broadcom seems to be the latest superstar. We've just seen this moonshot in the shares with them falling right behind Tesla as sort of the Magnificent Eight, and people are playing around with what the name could be. What gives you confidence that Micron's growth has that type of moonshot at a time where people are trying to imagine what the sort of evolution of AI adoption looks like?
I think when I think of Micron, I think of DRAM, I think of a global commodity that is actually going to be benefiting from some of the U.S. chip stimulus. But I think long term, you're going to see more and more DRAM across the board, and everything memory is extremely important. So I think about Micron in terms of that long-term cycle that right now probably is going to decline a little bit, but will come back up again later. Although last year, Micron was telling us that 2025 will be the peak. So it's a function of what overall tech adoption will be like in terms of hardware.
When you talk about your investments, you're investing on the tech side with Micron, but you're also very low tech with respect to just what people buy every day, maybe some of the Nature Valley bars that some people like, and Haagen-Dazs that some people like and enjoy.
Is that a staple?
Actually, in our household, it is a staple, and we go
for
through
many
a lot
households
of
across the United States of America.
And that's okay.
That's what they want to hear.
Some people grow up with Lucky Charms and turn out just fine. But I will just say, how much are you really going towards some of these staples, and why now?
We've taken a very conservative approach to investing right now, where we have large holdings in BJ, in Costco, in Walmart, across the board. One of the reasons for that is we're trying to go to where the puck is going. And at the moment, we're seeing a slowdown in AI adoption. I think we're seeing the opposite of the FOMO that we saw in the beginning of last year, where managements were virtually throwing money at GPUs. It was all about speed and scale. And this year, I think we've seen a significant transition in terms of how are you going to monetize this AI? What is it going to cost? What is the must-have app? And what is it going to cost on a long-run basis to operate the AI once you get past the training part?
But these names, Costco, Walmart, Target, it's where you can find good deals.
Precisely.
Do you see a slowdown in the consumer?
I think we're seeing a slowdown in the consumer already. I went to buy some coffee the other day, and a pack of 20 Starbucks K-Cups cost me $40. So I think that everyone's kind of migrating towards cost saving, but I'm literally thinking about what's going to happen to the S&P if there is a slowdown in tech. Where will that money migrate? And to me, the money is going to migrate towards more conservative, stable cash flow generating areas of the market. That being said, I think that Trump is 100% pro the market, and he's surrounded by extremely smart people. I think very highly of Scott Bessent. I think Elon Musk is one of the greatest innovators, just beyond this generation, obviously, maybe of all time. So I'm very impressed by the team that he's assembled. But That being said, I think that technology is on a cycle of its own, and we're seeing changes in terms of focus ROI. We're looking at intellectual property and security issues to consider, and also in terms of AI data governance also needs to be addressed.
You've been super gracious with your time already this morning, but this is not the reason you're with us. You're with us because you're participating in the Robinhood stock picking contest, whereby you have to pick one long and one short and see who wins over 6 months. We can put the leaderboard up on the screen. Can you share with us your long and short and what's behind each one of those picks?
So my long is BJ, just primarily generates a lot of cash flow, and I think that if GDP does slow down, I think the stock will be pretty resilient. My short is in technology. As I said, I think you're going to see a slowdown. I think right now, when you're looking at prices of GPU rentals, they've come down pretty considerably because there's a lot of server optimization. And once you've stopped trying to train your AI, you may have excess GPUs that now you're starting to re-rent to other people. So now it looks like there's a lot more competition on the GPU rental front. So longer term, that's extremely positive because it's going to lower the barriers to entry for new companies to come to train and create new business models. But in the short term, that may create some pressure for data centers and the chip manufacturers.
That is fascinating to me. How much do you think that that is underappreciated right now? I mean, that sort of speaks to the short position. Why do you think that's overlooked?
I think the CEO of Microsoft mentioned it last week when he said there's no longer a chip shortage. I think we were chip constrained for 18 months, but I think that started to resolve itself probably in the middle of this year. And now I think volumes are coming to the market, and you're seeing a large reseller market. You're seeing supply come onto eBay and Alibaba of entire GPU clusters, which is going to depress pricing.
And it's all for a worthy cause, so it's good to see you. And thank you for sharing that with us.
Thank you so much.
Thank you very much. That was Nikolayevsky there of Axel Capital Management.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.